Hello, and what's up, everyone? I hope you all are having a great time. And yeah, welcome to the new video. So, this is specifically uh, about one strategy which I found recently. I would be sharing the pros and cons, and also I will explain the reason why I'm sharing this. So, first, the disclaimer. Of course, this is one of those videos like which need disclaimer because like it could be followed blindly without any analysis. So many people will just follow it blindly. So this is necessary disclaimer. Everything I say is for entertainment purposes and entertainment purpose only. Nothing I say is any sort of any advice. Historic data doesn't guarantee future results. Always consult your financial advisor before investing or trading. With that being said, let's move to the video. This is about the Ikenash, Ikenashi chart type, which we find in TradingView or any other charting platform. So the main purpose of any charting platform or any chart type is to like sort information in a helpful way. So before getting into the strategy, I want you to understand how those charts are made. So you could be creative or make or understand why the strategy works or doesn't work at times. So it's just a different way of looking at charts. So basically, the open of this candle is is between like it is in middle in center of previous candles body. Body as in like open and close price. So 50% of that body's candle is the open of the next candle, not the open of the next time period, but it's the 50% of previous candle's body. Close is one fourth, like just say average of the open, low, high close of the current candle. It's the average. Maximum is just maximum. High is the just minimum. Low is the same thing. High, low is the same. So let's take an example over here to understand it. So previous candle open, low, high, close value is given here. So now if we look at it, so yeah, so body is just open and close. So the next candle's open would be 10 plus 17 divided by 2. That's 26. Sorry, that's 27 by 2. Like it comes around 13.5. So you can see the open is 13.5 over here. So and yeah, that's all there is from the previous candle. From the current candle, whichever is the highest becomes the high 20. Whichever is the lowest becomes the low 16. You can see 16 is in between. It's nowhere to be found because we opened at the 50% mark of the previous candle's body. And previous candle's body, 50% was 13.5, but the low of the candle, current candle, is 16. So there is no wick for this. Its low is in middle of it. And close is just average of all this values. Just add it up and it comes around 18. So this is the difference between like this candle, normal candle would look like this open, low, high, close. And this Hagenash is different. What you can see over here is like you can see the 50% of the previous candle's body getting defended or it is getting violated or it's getting pushed down. This gives us the confirmation if the trend is strong or like it is being weak or it is being tested. Here you can just look at price, what price is doing. There's no additional information. We just have to make thesis and look at it. But with Ikenash candles, it gives you the perspective, like if the 50% of the previous candle is being defended or it's not. So let's get into the strategy parts. So obviously it's still a candlestick. So same candlestick patterns again. So we could make a lot of sense out of a lot of patterns. But yeah, here are a few patterns which I found very repetitive and very useful for making a good trade. So this like any candle, uh, any regular candle, the next candle should be closing outside the whole range or just closing outside is sufficient, but it should be the opposite color. Then it shows there's a good strength, good point or reversal. Even if it is the same color, uh, let's say it was a bullish candle, then another bullish candle. So it becomes the same thing. It's showing more strength. So here's a bearish candle, and the next candle opened, the low pushed even below the close of the previous candle, then it closed above. This shows more strength. Likewise for the same. Next candle should be closing up outside. Next candle should touch the open. Yeah, sorry, touch the, yeah, same thing. So it's like doing a liquidity raid. You're doing a liquidity raid, and then just you are engulfing the open, close, and high. You're you're reading the whole open, close, and low. So these 3 points should be engulfed. These 3 points should be engulfed. Then it becomes a very strong candle. Not like it shouldn't, if it's closing in between or like between the body, this shouldn't be considered as a good trend or something. Someone might just consider it's closing outside the body. It should be also bullish or bearish thing. It doesn't work. It works sometimes, but the data I have tested, the results aren't profitable over a period of time. This thing, it's profitable over a long period of time. You get good trades, but like poor risk reward, but good win ratio. So I will now jump into the charts. Okay, I think you can see my charts now. Hopefully you are right. Okay, I think you should be able to see it now. So this is basically high Kineshi charts. You just need to select over here. These are the charts. Just select it and it's there. So currently it's on ES charts. So there could be multiple trade opportunities even if you just look at it. So let's just okay. So basically, what I said, you need to wait for a candle opposite this candle. The next candle should be closing below. It should be like pinpoint also, like be accurate with it. It helps a lot. So as soon as it does move below, take the entry stop loss below the first candle, and you might be entering over here. That I will come back in a while, like how it looks on a regular candlestick chart. So you can hold this trade. Oh, yeah, basically till this point you have to hold. Now here's the thing. Here's the point of using this idea. You got the whole move. But now here is your exit strategy. Exit strategy is the same thing. You are closing outside this, what we call, now you need what entry model you use, you need the same thing to exit. So now here you could see we closed above this, or you have to hold this. And you entered here, you went till this point, but you are coming back over here. So you won this time, but your risk reward is 9.4 over here for the time being. So yeah, you closed here, but now you entered a long position. This is your cue to enter long. It's not opposite side candle, but yeah, you can consider giving it showing signs of strength and all that stuff. So here, you made like 3.6 RR on, no, it's not 3.6, yeah, 3.6 RR. No, wait a minute. I think this is the right candle. Yeah, so this is the right candle you entered and you went till here, but your exit plan was given to you at this moment over here. You see the first candle that closed bearish or gave a bearish sign. So here, so this you got a good risk reward. You gave away some of your profit, but yeah, that's a part of the game in trading. But this is the idea you we trade with. So Yeah, now the deal here is like, how do we know or like what is the proper risk reward on this? So let's consider this candle over here. 22. It's like 22 is like 10, 10. Yeah, this is the candle over here. Yeah, this candle's close was your entry point. So let me mark it out. This was your entry, this was your stop loss, and you closed where exactly? At 110. Yes, 110. This was your closing point over here. So you got 8 risk reward over here. You see, this is the thing with this setup. You got 8 risk reward, but you traveled like 13, almost 14. You say, yeah, you've traveled more than 14, but you are getting only 8. Yeah. Yeah. So this is the drawback of the strategy. Like you will win a lot of fun, but yeah, being able to hold on, like you are losing a lot of money over here, but still you have to hold on because of the strategy. You could end up building more strategies around it. It's totally up to you. I have a limited data on it. I don't have a solid data. So yeah. So this was your closer, I guess. This candle. This was your close, given how the candle is closing at that time period. So this was your close. So you made like 4 hour over here. So now you get the idea, like how this works. So now let's take another chart. Bitcoin, like I've been testing this. Whatever I'm sharing, don't take it as a solid information. I am just testing it. I found very useful. Mm, okay, not too many. So let's start over here. I guess we are on. Let's change the time frame. We are on 5. Let's do it on 15. So yeah, here your entry. Where would it be? Yeah. So basically, let's start from here. This is your first bullish candle, bearish candle, bullish candle. So this would be your entry over here. We closed over here. Your stop loss would be under this, and you would target like whichever, like this candle didn't close below the previous candle's low, so you continue to hold on to it. Now this is your exit over here, this candle. So now let's see how does it look on your futures, which you will be trading. This was your entry. This was your entry candle. This was your stop. And your closing point was around this. The candle this was this. So this was your close. You made like 7.5 hour. So your this exit becomes your next entry point too. Cause like this is showing like bearish candle, the next close below. So it's giving like we already turned bearish and it's giving more bearish confirmation. Or you could just wait over for this candle. And yeah, so this would have been entries same, it's almost same. So you are targeting the first bullish close. So first bullish close was here. So this was your first bullish close. So now let's see how does it look on candlestick. That's kind of a previous one. A previous one. I didn't mark this everything, but I had to show you like how do we use it properly. So you made like 1:1 over here. Here it looks like 1:2, but in reality it's 1:1. So you made actually you went to like 2.3, but you are risking what you made. Like you are losing a lot on this, but it has a very good win ratio. So now Does it like, don't we give away stop losses? Yes, we do. So now here's the example. First, this was the first bullish close we entered. This was stop loss, and we hit a stop loss over here, and we gave it away. As simple as that. We gave it away. Next was the same thing. This bearish setup over here. Yeah, this bearish setup. We were out over here. I will delete it. Now it's confirmed that we made a loss there. Second one is like we entered a short position over here. We made a short position, but yeah, look where we gets invalidated. So here we lost another. So we gave away another stop loss over here. So this becomes your new entry point, and this is your stop loss over here. So now where would your exit be? It's the first bearish close. Where is it? Yeah, here. So you are holding it till this point. Yeah, next point. So yeah, let's see how does it look on the futures chart. This candle is your entry. This is your stop loss. Now where your actual exit was. Yeah, this candle. So you made like 2.6 R. So this continues, like you just took an entry, you closed that, you took an entry over here, your stop loss right above this. And yeah, where did you close? You should be ideally closing over here. So yeah, this was your close. That was your gain over there. Let's see how it looks on. This was previous. This was your entry. This was your stop loss. Yes, basically this was your exit. You made like 8 risk reward over here. So this works very fine, but uh, like I always tell you, or like anyone who is into trading, trading without context is gambling, and this strategy works. Like it's backed by numbers. The stats I have collected working, but it's still gambling. Like it's more gambling that I have ever known. Like you're just following it blindly. It worked because like it was given a context. So because we were above this point and we were just moving up and poor lows over here. A lot of liquidity. Like it worked. A lot of things come into this. It works. It's working, but it's pure gambling. If you want to use this in the long run, I personally am gonna use this because like it supports, like it goes with how I trade. It helps me hold longer. Like today's example, Nifty. Let me show you what exactly. Okay. So this was, let's move to the 5 minute. It's much clearer there. So you can see this was previous day's balance over here. And as soon as we opened, we wicked above and we moved below. So this shows like price isn't interested to move outside this. So my first insight was like as soon as we went below the today's open, idea was like just short it and target like previous is this, or like we also had a previous day poor low. This was a poor lows with a lot of liquidity over here. So ideally I was targeting that. And we also had like some levels which need to be tested from the previous week. So that was the main goal over here. So that was like how I contexted the market. But now, if I'm just trading solely based on this, so now this becomes my entry point over here. This is my entry point. This is my stop loss. This stop loss. And yeah, I look, here's the thing. I'm just pulling the line. You see where I should be closing. It should close, the candle should close above the previous candle where it's closing nowhere, no place, nowhere, not possible, not possible. Thing. It kept holding till this point. There was some candle. Yeah, this candle closed above. So this candle, you can see it just gave me how much? 3.4 hour. Let's look at this on the futures chart. Futures chart. So yeah, this was my entry. This was my stop loss, 50-point stop loss, crazy stop loss. Yeah, we could say I closed around this candle. Yeah, this candle. So I made like 2.3 RR on this, 3.4 RR on this. So this the difference is because of how the candles are structured. This gives confirmation to how long one should be holding it. So there are pros and cons of it. So I won't be using it, but if I'm in a short, I will be carefully looking at, not carefully, but I will just have overlook if it's showing weakness or something. Because ideally, I would have like just closed around somewhere over here and just logged it off. So yeah, basically it has its own pros and cons, given how it treats. Even like yeah, when you have a like a lot of bearish setup or like bearish bias, strong bearish bias or a bullish bias on the day, and you want to keep on holding to a bias. So like here we entered around this point. This was a stop loss. Yeah, here's just stop loss over here somewhere. And yeah, on this trade itself, you closed around break even because this was the first bullish candle. So that happened. But next candle, it was a bearish candle. And yeah, and you ride around like 100, 200 points. On options, it becomes crazier. So like first bullish candle, where is it? Yeah, in this one. So like you ride around like 200 points on options, you get a huge spike. So if you have a very strong bias, it could be helpful. But on most of the charts, those are range bound. There's another good use case of it is on the daily time frame. I should have covered this in the beginning, but it slipped my mind. So you see, like when we are like in a trends or here, so we closed over here above this candle and we did the whole rally. So now if we want to look at stocks or something like crude oil or something, crude oil, we had a huge rally till this point, like we almost gave everything away. But you get the idea, like how it could be used. And let's take some stocks, Reliance. You could see as soon as we closed above and we skyrocketed. But you can see we closed below, but we gave away stock. So like, yeah, we win often, but there's like we win very often, but yeah, we when we win, we make very less. So it's like slowly making you money, but over time. I don't suggest anyone to use it, but you get the idea. There's another major reason I am saying like there are many strategies which show mathematically it's profitable, but when you actually try to execute it, and yeah, there are a lot of examples, it won't just work. If you are trading without context, you without looking where the liquidity or like where there will be a lot of involvement will happen, you need to look at all this stuff. If you aren't looking at all this stuff, it's just gambling at the end of the day. I suggest like don't trade without a context, and this is like pure example. It's working somehow, but it's just another gambling strategy. So I would suggest uh, at least as 6 months on a paper trading account, then only think of trading, because I won't be mixing it. I won't trade it. I'm just looking it as a contextual thing. Like just give me like, is it showing weakness or not? I don't rely on it. It works, but it doesn't give me a context, like why and how. So is it? So be cautious. Like whenever you see like some strategies look cool, yeah, on paper and all that stuff, but in practicality, it will burn you out. So yeah, this is it for now.